Hello, Baker Investment students. Hope everyone is having a good weekend. It is Sunday, May 15th, 2022, and last week was a pretty rough week in the markets. So we'll see whether this volatility continues in your last week of the portfolio project. So everyone is doing a good job with that. Many lessons learned, and we also kind of see the importance of diversification. It's very hard just to have 5 to 10 stocks. And this leads to one of our topics, mutual funds, that you're going to be reading about this week. So it's kind of that balance of, yes, I could do this as an individual, save some money by not paying fees, but it's probably going to be really hard to diversify away all that company specific risk. So, well, we only have 2 weeks left. So again, this week you're going to read chapters 11, 12. You're going to learn a lot about bonds, more about duration, and you're going to have chapter 12 of mutual funds. You're going to do your homework, your final forum discussion post, and then this week you have the common assessment, the task stream assignment with the current investment topic project. So again, you want to pick something of a world event. Obviously, the war in Ukraine is a good example. COVID was a good example. You can go back in time and look at the subprime crisis with the credit default swaps and all how that impacted the entire stock market and industry and bond market. So I leave that up to you to choose what's going to interest you and what research topic you want to pick. But again, make sure to submit that, follow the instructions on the task stream assignment to make sure they get submitted. I want you to also submit it to Moodle too, but that way it will be in 2 places. But it is important to submit it to task stream, so it's kind of part of what we call the Higher Learning Commission's accreditation process in order to make sure our program is up to par and meeting all the standards to make sure you have quality degrees. So with that, let's just go over some things for this week in the readings. First, in the chapter 11, the bond valuation. You probably had some exposure to this in the corporate finance class, but you're going to go into a little bit more detail, especially with the topic what I call duration. And duration is one of those things that deals with the sensitivity of the bond's price to changes in interest rates. So we know as interest rates go up, which they're doing quite a bit right now, it's been a kind of interesting for you all to see this happening, where the Fed funds rate just went up 50 basis points, and then it's probably going to go up to like where it's at 1%, potentially 2.5%, and even more to try to tame inflation. So, but bonds have that inverse relationship. As interest rates go up, the present value goes down. Whereas interest rates drop, the present value goes up. So I own some bond funds through my retirement through Fidelity, and they have taken a beating during this time period. Some down almost 20%. Even though they're investment grade and corporate bonds that are mostly investment grade, there could be big swings in the prices. What I'm seeing is the net asset value. Let's say if the share price was at $12 and now it's approaching $10 a share, that's a pretty drastic difference because everybody's pricing in what's going to potentially happen to inflation and future interest rates. So with duration, what this concept does, and kind of walk through the math slowly, kind of help you understand that as you read that section. But it says, let's say, for example, that interest rates are rising. Well, there is the benefit of reinvesting as you get those coupon payments at a higher rate. So that's a good thing. But at the same time, the price is also dropping. So it's kind of these offsets of these two things that duration is calculating. And the shorter duration, the less volatility. So if you're a bond portfolio manager, you're obviously concerned about the price volatility because that also impacts the returns to your investors. So even though you may hold on to that bond until it matures, it's priced as what we call mark to market, as if you had to sell it today, what is it worth? And there are many people that may have to pull out of their cash for retirement reasons, whatever, so they're taking losses on those bond funds right now because they're selling for a lower price. So slow down the reading with that one. That will take a little bit of a time. If you have questions on that, do email me. The last one in chapter 12 with the mutual funds is all of us probably to some degree have had exposure to mutual funds through work or buying them individually. I have some friends that work at American Century. They're a mutual fund company that both cater to corporations and also to individual investors. In fact, when the market does well, my one friend Christine says American Century does well because they base their income off the size of their portfolios. Right now, they're losing money in that sense in their fees and everything. So mutual funds do have fees that they're paid to manage. You get a prospectus that says, hey, this is what we're going to invest in. Even my friend Christine, American Century, she works in the legal department, and she has to ensure that whatever the investors are buying meets that criteria in the prospectus statement. So if they want to go invest in something else, she's going to say, hey, wait guys, this is what you said. So we would have to get a vote. And sometimes you might get these in the mail that says, hey, please allow us to change this on this mutual fund. Most of the time it just goes to the recycle bin. Not a lot of people. It's pretty boring reading if you were looking at all the details of what they're telling you about in your mutual funds. It's kind of like the excitement of reading the actual details of the contract of a credit card statement when you agree to. Most people do not read it. But oftentimes they'll vote to kind of say, hey, we need to change this as market conditions change, so we need to change some of the information that we're providing to our investors about what we're trying to do. So with that, you're going to look at how mutual funds operate, the different types of mutual funds. You'll see how they calculate that net asset value. That's the nice thing about mutual funds is that you can own partial shares. You don't have to buy a whole share. But that net asset value, they have to do the accounting on the books every single day. In fact, my friend Christine, she used to do that as her job when she first got out of college at the University of Missouri. She helped calculate that net asset value in funds. So she was an accountant. Very complex process. But they had to figure out that, hey, if we own all these different investments, I take all the price of all these different, say, stocks, and sometimes, mutual funds can be balanced funds that have both stocks and bonds. So they have to figure out what the worth is of that fund and the number of shareholders and say, hey, this is the net asset value at the close of that day. So that way they know what to sell it at the following day. And then finally, probably the most important thing is the performance. And this is, when I started in this business many, many years ago, there weren't that many. Well, there were some mutual funds, but not that many. Today there are thousands and thousands of choices of mutual funds. It can be quite complex and confusing, and you're trying to determine which one is really the best price because, again, there are fees associated with this fund. In recent years, I'd say the past 5 years, there's been some question about the fiduciary interest of those managing your money because some of these fees, they can very much eat away at your returns over the years. So you have to find an investor that's willing to put you in a mutual fund that is really not making him or her a high commission. And, what are the fees associated with that mutual fund? Does it really justify the performance? I was always taught in graduate school many, many years ago in the 90s that the load funds versus the no load funds had done no better financially in their performance. So it's like, why would you pay extra fees to be in a load fund? But it's a very lucrative money-making thing for that industry. And the more that say someone that is selling a mutual fund can convince you to buy that particular mutual fund, it could help them in commissions and other make more money for them. So you got to be really cautious about this and understand the intricacies of what you're buying. So, and that's why I always tell my students, I think I still looked up yesterday the performance of the S&P 500 historically has still been 10.5% over the lifetime, even though we're seeing a really bad year. Really, there's no rocket science involved in buying an S&P 500 mutual fund. The cost should be very low, little fees, because you're not making any decisions. You're just buying those 500 stocks, and you're just tracking and following it. So, and that's why most professional money managers have a hard time beating that S&P 500. So, even though the S&P 500 has been doing so well lately. So, well, that's it for this week. We'll say just 2 more weeks. We're wrapping up very quickly, so just finish strong the last 2 weeks. If you have any questions, do let me know. I may try to do one last Zoom get-together in the final week. We'll kind of see about that. I might be in midweek, kind of see if there's some interest in it. But otherwise, again, do email me if you have questions, and I'll answer them. But look forward to your last forum discussion post. I'll jump in there as I can, but you may want to do those a little bit earlier in the week. I'm okay with you closing out on Wednesday, so you can focus on more of your projects in the last 2 weeks. So All right, have a great week. We'll talk to you online.